Everyone treats choosing a home loan like they're trying to predict the stock market. We listen to economists, we read the news, we try to guess, will rates go up or down? The entire financial news cycle is designed to make you feel like you have to be a market expert because that confusion keeps you dependent on their daily hot takes. We're essentially gambling with the biggest decision of our lives. But what if that's the wrong way to think about it entirely? What if you ignored the guesswork and used a simple framework that gave you the right answer for your life every single time? In this video, I'm not going to tell you what interest rates are going to do. Instead, I'm going to give you a proven 3-step system that ignores the guesswork and lets you choose the perfect home loan structure with total confidence. And the cost of getting this wrong isn't just a few dollars. It can be trapped in a loan you can't escape without paying $20,000 in break fees, or being denied the ability to upgrade your home when your family grows. This single decision dictates your financial freedom for years to come. And the first step has nothing to do with banks or rates, but it's the one that can save you from those massive fees. It's all about calculating what I call your 5-year flexibility score. You need to honestly assess your plans for the next 1 to 5 years because this will determine how much flexibility you truly need. Honestly, just ask yourself, what is the real likelihood I would sell this property within the next 5 years? A new job, a growing family, or a move to a new city could force a sale. Will my income change significantly? Think about things like promotions, career changes, or taking time off for parental leave. Do I expect to receive any large sums of money, like an inheritance or a bonus, that I'd want to use to make a lump sum payment on my loan? If you answered high likelihood to any of these, you have a high flexibility score. Your life is likely to change, and you need a loan that will change with you. If your life looks incredibly stable for the next 5 years, you have a low flexibility score. But knowing how much freedom you need is only half of the question. But a loan that is flexible but keeps you awake at night with worry is the wrong loan. That's why we need to uncover your budget stability score. This step isn't about your personality, it's about your financial reality. How much peace of mind do you really need when it comes to your budget? Honestly, ask yourself, on a scale of 1 to 10, how much would a sudden $500 increase in monthly mortgage repayments stress me out? An honest answer is crucial here. Is my household budget planned down to the last dollar, or do I have a significant buffer for unexpected costs? Am I the kind of person who sleeps better at night knowing my single biggest expense is locked in and will not change? For some people, a rate rise is an annoyance. But if your budget is tight, it's the sleepless nights before payday wondering if you've got enough to cover everything. That's the stress we want to eliminate completely. If you need that certainty and your budget is tight, you have a high stability need. If you have a solid financial buffer and are comfortable with some repayment fluctuation, you have a low stability need. Now, this is where the magic happens. Once you have these two scores, the entire complex world of home loans becomes incredibly simple. In step 3, we're going to plug them in, and the perfect loan type for you will become crystal clear. If you have a high flexibility score and a low stability need, you should lean towards a variable rate loan. A variable rate loan is built for flexibility. It generally allows unlimited extra repayments, and critically, if you need to sell or refinance, you can do so without facing massive break costs. You're choosing maximum freedom, but you need the financial buffer to handle the risk of rising repayment. This strategy also gives you access to the most powerful debt reduction tool there is, the 100% offset account. If you have a low flexibility score and a high stability need, you should lean towards a fixed rate loan. If your 5-year plan is rock solid and your budget is tight and the certainty of a fixed rate is powerful, it offers total predictability, shielding you from the stress of rising rates. You are trading flexibility for stability. You have to accept the strict limits on extra repayments and understand that if your plans do unexpectedly change, the break costs can be substantial. If you're somewhere in the middle, you should strongly consider a split loan. For most people, This is the ideal compromise. A split loan allows you to divide your mortgage, putting one portion on a fixed rate for stability and the other on variable. This acts as a hedge. You get budget certainty for part of your loan, while the variable part gives you the freedom to make extra repayments and, crucially, unlocks the ability to link your 100% offset account to your mortgage. So you've matched your loan to your personality. But for those who landed on a variable or a split loan, there's one final step the pros use to turn that flexibility into debt-crushing machine. The banks all offer this feature, but rarely explain that using it correctly is what separates an average mortgage from a mortgage-free future. This is what I call the loan accelerator, and its heart is the 100% offset account we just mentioned. Why don't banks shout this from the rooftops? Because when you use this feature correctly, the banks make tens of thousands of dollars less from you over the life of your loan. Think of it as a savings account linked directly to your loan. Every dollar you keep in your account is offset from your loan balance. Imagine your loan is $500,000, but you have $50,000 sitting in your offset. What happens? The bank can now only charge you interest on $450,000. Just like that, using it correctly can save you tens of thousands of dollars in interest and help you become mortgage-free years ahead of schedule. Most people just default to the lowest rate they see and the single mistake that can cost their financial freedom for a decade. But you don't have to. So let's forget about trying to be a fortune teller. The key to choosing the right home loan and removing all the stress of watching the news is to be a brilliant self-assessor. By using this 3-step framework, evaluating your flexibility, understanding your need for stability, and then matching that to the right structure can move you forward with confidence. But the best home loan isn't the one with the lowest advertised rate today. It's the one that is perfectly aligned with your life's blueprint for the next 5 years. As a mortgage broker here on the Gold Coast, this is the exact process I take my clients through. It's about building a financial strategy that fits your life, not the other way around. If you're buying in Southeast Queensland and want to help building your own personalized strategy, you can find a link to book a free consultation in the description below. And if you're a first home buyer in Queensland, you cannot afford to miss the information in the next video.